Wall Street spent the last week fretting about whether he'll really try to follow through with the less market-friendly aspects of the agenda. You know what comes to mind there? Major import tariffs. There's been a lot of speculation if he'll really be able to follow through, or maybe this is just a negotiating tactic with our trading partners. Call it the art of the deal. Or how much damage these plans could do to the global economy and the stock market. I say let's put the speculation aside for the moment and think about what we already know. Because we know how the stock market reacts when the Trump administration rolls out new tariffs and launches a trade war with China, even if what we saw in the first term was less aggressive than what he's proposing right now. That's why tonight we're going off the charts with the help of Jessica Inskip, the first woman on the active trader desk at Fidelity, who's now director of investor research at stockbrokers.com, as well as the co-host and founder of the Market Maker podcast. Because we want to get a better sense of the history here and what it means for the present without any emotions involved. As Mark Twain put it, history doesn't repeat itself, but it often rhymes. You know, I kind of like that more than that Karl Marx line about how history repeats itself versus tragedy than as farce. As far as Inskip sees it, even if history doesn't repeat directly, or even rhyme for that matter, it certainly echoes. So it's worth listening to the echoes of past Trump tariff actions to find out where we might be headed. First, take a look at a chart. This is a weekly chart of the S&P 500 from late 2014 through the very beginning of 2018. Now, the Obama administration actually tried to sanction a Chinese telco company in 2016 called ZTE, briefly prohibiting American companies from selling goods or services to them without a license. But they quickly backed down. In response, the stock market kept chugging along. But once Trump came in, we started an investigation of China's unfair trade practices for technology and intellectual property rights. Then he orders an investigation of Chinese dumping of steel and aluminum. Basically, they subsidize the stuff, and then their producers undercut us on price, crushing our own manufacturers. This has just been a constant pattern. By October 2017, the U.S. International Trade Commission was recommending safeguards to protect solar panels from Chinese dumping. So you can see this is a period of halcyon. We pull back from the ZTE, but then we go right forward. This was all the build-up to the trade war, and it didn't seem to have much of an impact on the averages. Even though the Federal Reserve was gradually raising interest rates during this period, Inskip says that the S&P 500 was still in a bullish trading cycle, with the 13-week, 26-week, and 40-week moving averages trending in the right direction. Remember, she likes these time frames because they represent one, 2, and 3 quarters, respectively. And we know we think about quarters on Wall Street. Now, let's take a look at this next chart. Check out the action in the S&P from mid-2017 through the very beginning of 2020. This is where we start to get the real tariff action from the first Trump administration. As Inskip points out, things get a lot more volatile, don't they? Trump imposed tariffs on steel, aluminum, solar panels, and washing machines, among other goods. All these helped the industries in question, but the broader market didn't like that we were triggering a global trade war. Sure enough, between January 22nd of 2018, and December 24th of 2018, the S&P 500 lost 18% of its value, all right? Of course, some of that's because the Fed got much more aggressive about raising interest rates during this period, taking them up 100 basis points that year. But it definitely wasn't just the Fed. You can see from the chart that virtually every time we got more tariffs, the S&P would roll over. Every time China retaliated, we'd sell off. So you're looking at this. All right. Of course, once the Fed decided to stop tightening at the very end of 2018, the S&P was finally able to find a floor at the 200. This is the 200-week moving average. You see that's the intersection of the floor.
The incoming Trump administration is gearing up to potentially alter the global commerce landscape, and the companies most affected by this happen to be the biggest, Nvidia and Apple. With President-elect Donald Trump at the helm, investors find themselves on the edge of their seats. Reports of sweeping tariffs on several nations, particularly a staggering 60% on China, have turned heads and opened a new chapter in the ever-evolving saga of trade relations. As the clock ticks down to when these tariffs could be realized, all eyes are on Apple and Nvidia, grappling with the potential impacts on their business models. Welcome back to Investocracy.
According to Inskip, that catalyzed a bullish trading cycle, one that continued until COVID hit in 2020. Long story short, the market couldn't handle the trade war when the Fed was tightening. But as soon as the Fed started easing, well, those losses evaporated. What does this mean for the present? Let's take a look at a weekly chart of the S&P going back to October of 2023, unlike 2017 and 2018. The Fed is now our friend, creating a much more benign environment for the bulls, okay? Of course, we know from back then that Trump used tariffs as a bartering tool, with the averages selling off sharply nearly every time some new tariff threat materialized. But as soon as the Fed stopped tightening, okay, as soon as it stopped tightening, the market stopped reacting as aggressively to the trade war. The Fed was in play, not the trade war. As Inskip sees it, something like a trade war can certainly hurt us badly when the market's already trending bearishly. But if we got a bullish trading cycle like we do right now, then she's not worried as long as we can maintain that cycle. Right now, Inskip notes that the S&P 500 is very much in bull mode, supported by key technical indicators. It found a floor of support on Election Day at the 13-week moving average, triggering a short-term rally. The 13-week, 26-week, and 40-week moving averages are all acting as strong support levels. Even if we get a big breakdown from here, Inskip thinks we have a very strong floor at 5757. As long as that level holds, the bullish trading cycle remains intact. Wow. In that case, she's betting the S&P can digest the damage from a trade war, in large part because the Fed's our friend right now. When the Fed's your friend, it's easy for the bulls to sweep all sorts of negatives, including tariffs, under the rug. Finally, what about short-term catalysts? All right, Cramer fave, NVIDIA reports tomorrow after the close. So check out the weekly chart of NVIDIA going back to October of 2023. Pretty dispositive.
The ramifications of these potential tariffs are multifaceted and intriguing. Apple, known as a consumer tech titan, finds itself in a precarious position due to its substantial reliance on Chinese markets. In 2023 alone, China accounted for nearly a fifth of Apple's revenue, with iPhones and various other gadgets being churned out in high volumes to meet global demand. If the proposed tariffs come into play, the pricing dynamics for Apple's products could transform drastically. Concurrently, we watch as Nvidia wades through these choppy waters with resilience. Unlike Apple, Nvidia's manufacturing is intricately linked with Taiwan Semiconductor, and any disruption there could ripple across global supply chains. Yet, Nvidia's internal assurance remains unfazed. But before going on with the video, are you into cryptocurrency? If so, check out our second channel, Investocracy Crypto. We bring you breaking news, expert analysis, and the latest trends in the fast-moving world of digital assets. Whether you're a seasoned crypto investor or just curious about the future of finance, we've got something for you. Click the link in the description to subscribe to Investocracy Crypto now. Don't miss out and stay ahead of the game. Now, let's get back to the video.
We start off with Apple losing its top spot at the market in China. Shipments to the country plunging 17% in 2024, according to research firm Canalys, with a whopping 25% drop in just the fourth quarter. That was Apple's worst yearly decline ever and put it into third place behind China's Vivo and Huawei. The stock falling over 4% today for its worst day since August. It's now lost nearly 9% already in 2025, making it by far the worst performing Mag 7 stock so far this year. Analysts on Wall Street have also been getting a bit more bearish. Just last week, MoffettNathanson issued a rare sell rating on the stock, slashed its price target, saying Apple could fall another 18% from here. The biggest concern there, tariffs. And with President-elect Donald Trump just a few more days from returning to office, could that threat just be starting? I guess at the heart of this whole thing is there more pain ahead?
You know, there's an interesting word in the English language, swashbuckler. Are you familiar with this?
It's usually associated with...
It's like a pirates.
Yeah, thank you. See, Tim
thank
knows.
you. Thank you.
And I think for MoffettNathanson, for example, to make a call like that in the midst of what was that's a pretty much a swashbuckling move, going against sort of being out there, right? And I sort of admire it. I'll say this, where we traded down to today, right to the moving average. But we've seen moves of this magnitude before. And I think finally, some of the China concerns that I've had, and they've been incorrect to have, but are starting to come to fruition, I think valuation is coming to the forefront as well. So you get through this level, then I think the November low of 220 is in play, and it feels as though it's going to continue to trend towards those levels.
Seems like there are a lot more question marks about the upgrade cycle and the strength of that upgrade cycle based on AI offerings, seeing that there are very few AI offerings that are actually compelling enough for people to pay a lot more money for a new phone, Bonawyn. So that plus the possibility of Apple not necessarily falling into the crosshairs of tariffs that we put on China, but retaliatory tariffs that China will take on U.S. companies.
Well, it would make sense. I mean, they're one of the largest operators, and if you look at that whole greater East region, it's about 16% of revenue. So the implications are significant here, and from a top-line standpoint. You know, again, you still do have that service business. You have a significant install base, and as guys pointed out numerous times, when you just talk about the passive income flows, the passive ETF flows, Apple is always going to be a significant portion. The real question is, do you want to be overweight versus the S&P? Do you want to be adding Apple as a singular equity holding versus the rest of your portfolio? And I think right now, going into a situation where, one, the AI supercycle is not even a factor in China. So that there is already a reason for them to look for local competitors. But in terms of them offering something that's a compelling reason for you to pay an upgrade now doesn't really seem to be there. And so I would be hesitant to add. But I do think, as guys mentioned, there is a floor to the price in the short term.
Nvidia's margins may be more than a mere psychological crutch. The geopolitical engagement with Taiwan, a link Nvidia shares, yields unknowns akin to whether Apple's tariff exception history could repeat. As these technology behemoths zigzag through impending possibilities, it's Nvidia's merits that appear to paint a clearer success trajectory. But before going any further, if you made it this far into the video, thank you. These videos take a lot of effort and time to make, so if you enjoyed them, please hit the like button and subscribe to the channel. This goes a long way in helping us grow. That said, back to the video.
Yeah, I think you're buying weakness in Apple. And I think there's nothing about the China market share loss that we haven't been hearing about for a long time. This didn't just happen. And in the fourth quarter, so they were number one, actually, but their sales year over year were down 25% for the fourth quarter. So the issue is absolutely partly the headlines from U.S. China. Are we getting worse? Are we ratcheting up? But I mean, I would have thought in the days of when we were really putting the screws to Huawei or Xiaomi that China would have already gone after Apple. We know they play the long game. I guess I look at the price of Apple, and I understand that the valuation isn't terribly cheap. But when I at least hear about people say, well, look, there's not going to be a real upgrade cycle, and there's no real AI, I don't see that in the price. I don't think there's any really AI dynamic in the price, and I think people will continue to refresh and upgrade Apple. The hardest part about this trade are not the headlines today. It's that Apple trades at 33, 34 times forward. And depending on where you believe you should put a multiple on their services business, and depending on what you think is really the outlook. Let's also not forget, if you think about the ASP in the Apple phone, it's gone higher. The gross margins have actually held their ground, which is nice. When you think about China, that ASP is getting harder and harder for a lot of people. And the domestic competition, they're very good phones. They're very good phones, and they're significantly cheaper, and there is a buy local mentality.
As the market braces for the realignment of trade policies under Trump's administration, the resulting effect may set off ripples throughout the tech industry and wider economy. Nvidia appears poised with a strategically defensive stance, leveraging its formidable margins and currently hyperactive demand. Meanwhile, Apple must navigate a more precarious tightrope, balancing on the possibilities their previous tariff exemptions once afforded them. What's your play in this unfolding drama? We'd love to hear your thoughts. And finally, if you would like to know what companies like Nvidia have been up to these past few days, go ahead and click on the next video on your screen. See you there.